Welcome back to the channel. Today we are diving deep into one of the most compelling stories in the commodities market right now. Silver has extraordinary volatility in early January 2026. After an absolutely historic rally that saw silver surge approximately 150% throughout 2025, the white metal has entered the new year with wild price swings that have left many traders wondering, is the rally over, or is this just a healthy correction before the next leg higher? In this video, we'll examine the technical patterns, support and resistance levels, and the key factors driving this volatility. We'll look at what the charts are telling us, what professional analysts are saying, and most importantly, we'll help you understand the technical framework you need to navigate this market environment. This is purely educational content for observational purposes, so let's get into the analysis. Section 1. The current state of silver. 135. Let's start with where we are right now. As of January 8th, 2026, silver is trading around $74 per ounce. Just to put that into perspective, silver started 2025 at roughly $28.89 per ounce. That means in just over 1 year, silver has gained approximately $45 per ounce, representing that extraordinary 150% plus increase we mentioned. But here's where it gets interesting from a technical standpoint. The first week of January 2026 has been characterized by extreme volatility. On January 5th, silver was valued at $76.54. By January 6th, it had climbed to $78.54, marking a $2 increase in just 1 day. Then, on January 7th, we saw it pull back to $77.04 before dropping further to $74.16 on January 8th, a decline of nearly $3 in a single session. This kind of intraday movement, where we're seeing swings of $2 to $5 per ounce on a regular basis, is significant. To understand what's happening, we need to look at the technical structure that has been built over the past several months and the critical levels that traders are watching. From a historical perspective, this rally has been nothing short of remarkable. Silver broke through the psychologically important $50 level, which had acted as resistance for over 4 decades since 1980. When silver attempted to breach this level back in 2011, it failed and entered a prolonged consolidation period. The 2025 breakout represented a fundamental shift in market structure. During the final week of 2025, particularly in what traders call Ghost Week, that low volume period between Christmas and New Year's, silver reached an intraday high of $83.75 on December 29th. Some sources report it touching as high as $85.85 before pulling back. This peak represents the high water mark that technical analysts are now using as a key reference point. Section 2. Key technical levels. 5 into 9. Smacked. Now let's talk about the technical levels that matter right now. Understanding support and resistance is fundamental to reading any market, and silver currently has some very clear levels that are being closely monitored. Starting with support, the most immediate level that analysts are watching is in the $73 to $75 range. More specifically, multiple technical analysis sources identify 73.36 and 73.85 as near-term support zones where buyers have been stepping in. This area has been tested multiple times in early January and has held, which is technically significant. The next major support zone sits at 70 to 71. This level is particularly important because it represents roughly where silver closed out 2025. The fact that December closed around $71 to $72 per ounce means this area has now become a psychological level for traders. If silver were to decline below $70, it would technically negate some of the year-end strength and could trigger further selling from momentum-based trading systems. Below that, we have stronger support levels at $69 to $70. And if things really deteriorated, there's another support zone identified around $66.30 to $67.50. These deeper levels represent areas where longer-term technical indicators suggest substantial buying interest would emerge. On the resistance side, the picture is equally clear. The most immediate resistance sits around $78 to $80. We have seen silver make multiple attempts at breaking through the 78 level in early January with mixed success. This zone represents overhead supply, likely from traders who bought at higher prices and are looking to exit break-even or with minimal losses. The more significant resistance zone is between 82s and 84. This area is particularly important because it encompasses the December highs. Several technical analysis reports specifically cite $82.60 to $83 as a stubborn resistance zone where silver has repeatedly encountered selling pressure. Getting through this level on a sustained basis would be technically significant and could open the door to much higher prices. If silver were to break above $84, the next targets that analysts are discussing include the $85 to $90 range. Some technical projections based on chart patterns, which we'll discuss in a moment, suggests that silver could potentially reach toward $100 if the bullish structure remains intact and fundamental drivers continue supporting higher prices. Section 3. Chart patterns and technical indicators, 13 through. Let's dive into the specific chart patterns and technical indicators that traders are analyzing right now. This is where technical analysis gets really interesting because we can see how historical patterns might provide clues about future price action. One of the most discussed patterns is what's called an ascending broadening wedge. This pattern has been forming on the daily chart, and it's characterized by higher highs and higher lows, but with expanding volatility. The wedge pattern suggests strong bullish momentum, but also increasing volatility within that bullish structure. According to technical analysts, this pattern has short-term targets in the $85 to $90 range, with the target potentially increasing as the price moves higher over time. Looking at longer-term patterns, silver has completed what technical analysts call a cup and handle formation. This is a classic bullish continuation pattern. The cup portion formed over multiple years as silver consolidated below $50, and the handle was the final consolidation before the breakout above 54. Additionally, analysts have identified both an Adam and Eve's pattern and an inverted head and shoulders formation on the daily time frame. These are both traditionally bullish reversal or continuation patterns. The inverted head and shoulders pattern is particularly significant in technical analysis because it often marks the end of a downtrend or consolidation period and the beginning of a new uptrend. Moving to technical indicators, the Relative Strength Index, or RSI, has been showing interesting readings. As of early January, the RSI on various time frames has been showing values around 42 to 45, which is actually in neutral territory, neither overbought nor oversold. This is notable because after such a strong rally, we might expect to see persistently overbought readings. The fact that RSI has cooled off suggests that the market has been working off some of the extreme momentum from late 2025. However, it's worth noting that during the peak of the rally, RSI was showing overbought conditions, which is typical of strong trending markets. The current neutral readings could be interpreted in two ways, either as a healthy reset that could precede another leg higher, or as early signs of momentum loss. The MACD, or moving average convergence divergence, has shown a bearish crossover on some time frames, suggesting short-term downward momentum. This crossover occurs when the faster moving average crosses below the slower one, and it's often used as a sell signal or at least a warning that upward momentum is fading. Bollinger Bands, which measure volatility, have been tightening in some periods. When Bollinger Bands contract, it often precedes a significant move in either direction. The question becomes, will the next expansion be to the upside or downside? That's what makes this setup so interesting from a technical perspective. Moving averages are also crucial here. The 50-day moving average is being watched as potential resistance, with some analyses suggesting it might be around $80. Meanwhile, the 200-day moving average serves as a key long-term trend indicator. As long as price remains above this level, it indicates that the overall trend remains bullish from a technical standpoint. Section 4. The Index Rebalancing Factor, 1330 to Trost. Now, there's a specific technical event happening right now that's contributing significantly to the January volatility, and it's important to understand because it's temporary but impactful. This is what's called index rebalancing, and it's creating substantial selling pressure that has nothing to do with the fundamental value or technical outlook for silver. Here's how it works. Major commodity indices managed by Bloomberg and S&P Global periodically adjust the weightings of different commodities in their indices to reflect current market conditions. These indices have approximately $120 billion in passive fund assets tracking them. When an index rebalances, these passive funds must buy and sell positions to match the new weightings, regardless of their view on any particular commodity's future direction. For silver specifically, this rebalancing is significant. The Bloomberg Commodity Index is reducing silver's weighting from 8.19% in 2025 down to just 3.94% in 2026. Similarly, the Goldman Sachs Commodity Index is cutting silver's weight from 1.23% to 0.65%. These are substantial reductions. Based on estimates, approximately $6 to $7 billion worth of silver futures need to be sold by passive funds over a 5-session period that began on January 8th. To put that in context, that's enormous selling pressure being applied to the market for purely mechanical reasons, not because anyone has a negative view on silver's fundamental or technical outlook. This rebalancing related selling began on January 7th when silver reached $82.75, but then closed lower. The following day, January 8th, silver swung violently between $73.85 and $79.02 as this mechanical selling hit the market. The gray metal was down about 2.7% during that session. From a technical analysis perspective, this kind of known temporary selling pressure creates what we might call a false signal environment. Price action during these rebalancing periods does not necessarily reflect actual market sentiment or the balance of supply and demand. It's more like a technical aberration caused by the structure of how commodity indices work. The key question for technical traders is, once this rebalancing pressure is complete, which should be by mid-January, will we see a technical bounce as that selling pressure is removed? Or has the rebalancing pressure simply accelerated a technical correction that was due anyway after the extraordinary gains of 2025? This is where watching those support levels we discussed earlier becomes crucial. If silver can hold above $70 during this rebalancing period, it would technically suggest that underlying demand is strong enough to absorb this mechanical selling. That would be a bullish technical signal. Conversely, if we break below $70, it might indicate that the market was technically ready for a deeper correction regardless of the rebalancing. Section 5. Longer-term technical structure. 17 and 21. So on. Let's zoom out and look at the bigger technical picture, because understanding the longer-term structure is essential for putting current volatility into proper context. From a multi-decade perspective, silver has broken out of one of the longest consolidation patterns in commodity history. The $50 level acted as a ceiling for over 40 years. Silver briefly touched this level during the Hunt Brothers episode in 1980 and again during the 2011 commodity boom, but it couldn't sustain levels above it and fell back into a range-bound market. The 2025 breakout above $50 and then the subsequent rally through $60, $70, and testing $80 represents what technical analysts call price discovery mode. When a market breaks out of a multi-decade range, there's no historical resistance or reference points above the breakout level. The market is literally discovering what price levels attract sellers and buyers in new territory. This is both exciting and dangerous from a technical perspective. In price discovery mode, volatility tends to increase because there's no established value consensus. We saw this play out in the wild swings of early January. Without historical reference points, markets can overshoot both to the upside and downside as they search for equilibrium. Looking at annual closes provides another important technical perspective. Silver hasn't had a yearly close above $31 in over 4 decades. The 2025 close at approximately $71 to $72 represents the highest yearly close in silver's modern trading history. From a pure technical standpoint, this is extraordinarily significant. Annual closes carry weight in technical analysis because they represent the final verdict of all trading for that year. The fact that silver closed 2025 so far above any previous year suggests a fundamental shift in the technical structure of the market. When we see this kind of technical breakout on an annual basis, it often leads to sustained moves in that direction as trading systems and algorithms that use longer time frames adjust their positioning. Another important longer-term technical indicator is the gold to silver ratio. This ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged between 40 and 60 to 1. However, in recent years, it expanded dramatically, reaching levels above 100 to 1 during certain periods. As of early 2026, the gold to silver ratio has declined to approximately 70 to 82, depending on the exact prices on any given day. This compression in the ratio is technically significant. When the gold to silver ratio falls, it means silver is outperforming gold. If this ratio were to continue moving toward its long-term average of 40 to 60, silver would need to gain substantial ground even if gold prices remain stable. From a technical analysis perspective, watching this ratio can provide clues about relative strength. The ratio has historically peaked right as silver prices bottom out. After those peaks, as the ratio begins to decline, silver often enters extended bull markets. The current declining trend in the ratio suggests we may be in the early to middle stages of such a move, rather than at the end. Section 6. Volatility analysis and what it means. 21 taught at 24:30. Let's talk specifically about volatility, because understanding volatility is crucial when analyzing silver, especially in the current environment. Silver is inherently more volatile than gold, and January 2026 is providing a textbook example of why. Looking at the actual price swings in early January, we're seeing daily ranges of 3% to 4% in some sessions. On January 8th alone, silver swung from a low of $73.85 to a high of $79.02, a range of over $5. That represents about a 7% intraday range. For comparison, gold's typical daily range might be 1% to 2% under similar market conditions. This higher volatility in silver compared to gold has several technical implications. First, it means that technical indicators designed for less volatile markets may give more false signals in silver. Stop losses need to be placed wider to avoid being shaken out by normal volatility. Position sizing needs to be adjusted to account for the larger potential swings. From a technical perspective, increased volatility can be interpreted in different ways depending on context. In a trending market, expanding volatility often accompanies strong moves and can be bullish. However, when volatility expands after an extended rally, it can also signal indecision and a potential top. One specific volatility metric that traders watch is the 1-month silver lease rate. This measures the cost to borrow silver for 1 month and can indicate stress in the physical market. According to recent data, the 1-month lease rate has eased from over 7% down to around 4.46% as of early January. While this is still elevated compared to historical norms of 0.3% to 0.5%, the declining trend suggests that some of the extreme tightness in the physical market may be easing slightly. Technical traders also watch implied volatility in the options market. When options traders expect larger price swings, implied volatility rises, making options more expensive. The current environment of high realized volatility combined with uncertainty about direction is exactly the kind of situation where implied volatility would be elevated. From a practical technical analysis standpoint, high volatility environments require adjustments to strategy. Chart patterns may play out faster and with larger magnitude. Support and resistance levels might be tested more violently before holding or breaking. Momentum indicators can swing more rapidly between overbought and oversold readings. Section 7. Technical scenarios for 2026, 24 to 30, 28. Based on all the technical analysis we've covered, let's outline 3 potential scenarios for how silver's chart might develop through 2026. Remember, this is for educational purposes to understand how different technical setups might unfold. Scenario 1 is the bullish continuation case. In this scenario, the current volatility and pullback from the December highs represents a healthy correction within an ongoing bull market. Technically, this would mean silver holds support above the 69 to 70 range and then forms a higher low. From there, it would retest the $82 to $84 resistance zone, break through it on a sustained basis, and target the $85 to $90 range in the near term. The technical indicators supporting this scenario would include the 200-day moving average continuing to slope upward with price remaining above it, RSI bouncing from neutral territory back into bullish range above 50, and the MACD generating a new bullish crossover. Chart patterns like the ascending broadening wedge would complete their measured moves. If this scenario plays out, some technical analysts suggest that $100 becomes a realistic target later in 2026, particularly if the fundamental drivers we haven't discussed in detail continue to support higher prices. Scenario 2 is the consolidation case. In this scenario, silver has gotten ahead of itself technically after the 150% rally and needs a more extended period of sideways movement to digest those gains. Technically, this would manifest as silver trading in a range, probably bounded by $70 on the downside and $80 to $82 on the upside, for an extended period, perhaps several months. During this consolidation, we'd expect to see technical indicators oscillating within neutral territory. The chart would form what's called a rectangle or trading range pattern. Volume might decrease as the market works off the excess bullish sentiment from the 2025 rally. This scenario isn't necessarily bearish. Consolidations often precede further advances. They're like a rest period where the market establishes a new technical base at higher price levels before the next leg up or down. Scenario 3 is the correction case. In this scenario, the technical indicators and price action suggest that silver has completed a significant rally phase and is entering a more substantial correction period. This would involve breaking below the $69 to $70 support and potentially testing deeper support levels at $66, $65, or even down to the $60 level that was so significant during the initial breakout. Technical signs of this scenario would include price moving below key moving averages, particularly the 50-day and possibly the 200-day. Declining peaks and troughs establishing a downtrend and bearish chart patterns forming like a head and shoulders top or a descending triangle. It's important to note that even in this scenario, if the long-term bull case is intact, corrections of 30% to 40% from peak to trough are actually quite normal in commodities and don't necessarily signal the end of a bull market. Conclusion: 28 August 30 Seuss. So, is the silver rally over? Based on purely technical analysis, the answer is it's too early to say definitively, but the market is at a critical juncture. What we can say from a technical perspective is this: silver has broken out of a multi-decade consolidation pattern, which is hugely significant. The current volatility and pullback from the December highs is happening in the context of that larger bullish breakout. The January volatility is being exacerbated by temporary factors like index rebalancing, which creates noise in the technical signals. The key levels to watch are clear. Support at $70 to $71 is crucial. As long as silver holds above this level, the technical structure remains bullish. A break below would suggest we're in for a deeper correction. On the upside, A sustained break above 82 to 84 would be technically significant and could open the door to rapid gains toward $90 and potentially $100. The technical indicators are mixed right now, which is typical after a strong rally. We're seeing some momentum loss on shorter timeframes, but the longer-term structure still looks constructive. The extremely high volatility is something that silver traders need to be prepared for. This isn't a market for the faint of heart. From an educational standpoint, what January 2026 is teaching us is the importance of understanding both technical levels and market structure. Not all price movements are created equal. Some volatility comes from fundamental shifts in supply and demand, and some comes from technical factors like index rebalancing. Being able to distinguish between these is part of becoming a more sophisticated technical analyst. Whether you're watching silver for potential trading opportunities, or you're a long-term investor trying to understand the technical picture, the current environment offers a fascinating case study in how markets behave during breakouts from long-term patterns and how they handle volatility in price discovery mode. As always, what we've covered here is educational content for observational and learning purposes. Technical analysis is a tool for understanding market structure and potential scenarios, not a crystal ball. Markets can and do move in unexpected ways, which is why risk management is always crucial. Thanks for watching. If you found this technical analysis helpful, please give this video a thumbs up and subscribe to the channel. Leave a comment below with your thoughts on silver's technical setup, what levels you're watching, and what scenario you think is most likely. I'll be following up on this analysis as 2026 progresses, so stay tuned for updates as the technical picture evolves. Until next time, trade safely and keep learning.